everyone. Welcome to the first episode of the WalkerLieb Show. I'm here with Matt Maltese. He works with Supreme Lending here in Las Vegas. He's a mortgage lender, and we're going to be talking about all things lending and real estate. So Matt and I have a connection through Santa Clara University. So for all of you Santa Clara grads, we got a couple here for
Go Broncos.
And we're going to be chatting a little bit about Vegas and everything. So we're actually just connecting before we started here, and we're talking about all the things to do here in Vegas and hiking and everything. And we were talking about Red Rock and Zion, and I guess Matt here takes his boys out doing some pretty serious some hiking, huh?
Yeah, they got into rock climbing 2 years ago, and I was a little disappointed because I was hoping they would make it to the major league, play for the Yankees maybe, but so they got into rock climbing. I was like, huh, but it's been amazing. I got into it with them, started climbing with them, and now we get to go out and spend the day together and just enjoy the beautiful scenery that's right in our own backyard. So it was an unexpected activity that they got into that I'm so thankful, so glad they did. So it's been a blast.
Yeah, that's awesome. For those of you who don't know, Vegas has Red Rock right down the street from actually where we're sitting. It's one of the most gorgeous places you can visit outdoors. And
yeah, they say it's one of the top rock climbing destinations in the world. I live right by there, so I go to the grocery store all the time, and you see these people from all over the world, rolling out of their vans and getting a snack, and you can tell they're on their way, based on how they're dressed and all that, on their way to enjoy some rock climbing. So it's pretty amazing that we've got this gem, hidden gem, right in our own backyard.
Are you in the Paseos? Is that where you are?
Yeah.
So he's right next door to it then, and you're down the street. So we're actually right next to the Las Vegas Golden Knights training facility over here, the City National Arena, and he's actually in the City National building over here. So
yeah,
he's got quite the location in town.
Yeah, absolutely. I love it. Everything about the area, and Las Vegas is, people ask. I grew up in New York, and I talked to a lot of my friends back east, and everyone asked like, "Hey, you ever gonna move back?" And there's no way you can pay me $1 million to move anywhere. I love Las Vegas, especially this area.
All right, so Matt is an awesome guy, obviously. He's into outdoors and loves Las Vegas, but we're going to segue into talking about loans and the actual business side of things. So let's get started. How long have you been doing lending?
All right, so I graduated Santa Clara in '98, and it was my first job after college.
Really?
So the only other job I had prior to that was a garbage man. So I've been in the mortgage business for 19 years, and it's
awesome.
It's all I know other than trash.
Very cool. And so you're with Supreme Lending. What's your title over here, and what are some of the things that you do?
So producing branch manager. Ultimately, I help clients choose the right loan program for them, and then help them secure the loan and get the financing in a timely, orderly fashion. I'm also a manager, so I have a couple of loan officers that work on the team as well, and work in a mentorship capacity to help them, understand structuring the loan and making the right recommendations to the clients.
So what's the process look like for a buyer? What do they do when they're starting to look for a home? What should be their first steps?
Yeah, it's really basic. Ultimately, you're going to fill out a basic loan application, and it starts out so simple, right? But certainly that's where the expertise comes in, as far as a loan officer that has a lot of experience and knows how to structure the loan so that the underwriter will approve the loan. So you're filling out the loan application. The loan officer then pulls credit, and then runs it through an automated underwriting system. So essentially the computer is going to say yes or no. And from that...
Well, what documents do they need when they're doing that? What do they need to provide you?
They should be providing a pay stub or two, and then 2 years worth of tax returns and W-2s. And you're talking about tax returns, just make sure it's all schedules and all pages. The front page is just a summary of your financial picture, but the details are in the number of pages behind it. So it's always important to have the full tax return.
What are the most important things for people to focus on when trying to get pre-approved? Is it income? Is it credit? Is it assets and bank account? What should they be focusing on?
They're all the things you mentioned are certainly a component to getting the loan approval. So from that, we start with the basic picture of how they look today, going over what they want to accomplish, how much they want to borrow, what they want their mortgage payment to be, how much they have down. These are all things that the loan officer then is going to take the wheel and help recommend. If there's maneuvers to be made to improve the financing terms, then those maneuvers need to be recommended and explained to the buyer so that they can put themselves in the position to get the best possible financing. So that's where the expertise and what I call the diagnosis comes in. The loan officer is critical that they coach the client up on how to get the best possible financing.
So from my understanding in working with Matt in the past is that is what separates a good loan officer from a bad one. It's who will help guide you in the right direction. So Matt, and I think this is probably what does separate him, and he can provide a little bit more clarity on that, but it's his ability to give you the proper information in all of your options, because there is a giant array of different loan types, things you can do, ways to organize it. And if you have a lender who's unaware or who doesn't really care about you, you might not be given the best loan structure, and that could greatly affect your finances for 30 years, because that's what we're talking about with a mortgage. So anything that you would like to comment on that and what kind of separates loan officer versus loan officer?
Yeah, great points. It's a number of components, but the two off the top of my head that I can think of that are most important is just really understanding the loan guidelines. There's conventional loans, there's FHA loans, and then there's VA loans and jumbo loans. And ultimately, they all have their own set of guidelines, and you really have to be an expert in them to help guide the client through the challenges of getting the loan secured. Lending today is much different than 10 years ago, and it's much more stringent. So without knowing all the ins and outs of the guidelines, you could be setting your client up for a disaster, in the sense that you send them out, because to further answer the question from earlier is, what does the loan process look like? Well, initially, when you get pre-approved, the underwriter's never looked at your file. So you're basically out there shopping for a home on the loan officer's assumption that the loan would be approved.
Right.
So the underwriter's never looked at it, and you're basically going off of the loan officer's interpretation of how the underwriter's going to look at that file. So the loan officer has to really, really know not only the guidelines, but also the underwriter and how they underwrite files, their tendencies, so that the worst thing that could ever happen is a buyer gets pre-qualified, they're pre-approved, they find a house they love, they're emotionally invested, they pay for the appraisal, they pay for the home inspection, they've got movers lined up, their family's coming into town for the holidays. I don't mean to smile, I just feel like I've lived it.
Okay, so that's the nightmare, actually.
Yes.
Is I've gone through this where I've been working with a client who chose another lender, and it all falls apart, and Matt has to come in and save the loan, which is a horrendous situation, because you have paid for an appraisal, you've paid for the inspection, and now you figure out you can't get financed. That's why it's so important to pick the right loan officer when you start, and to make sure that everyone's on the same page in a team. You want to have your real estate agent on board, you want to be in communication with everyone, your loan officer on board. Everyone needs to be on the same page and working you through it.
Yeah, and to dive deeper on that topic, it's important for me that I work with underwriters that I'm comfortable with because I know their tendencies. I can pick up the phone, I can talk to them, we can talk through a situation. So the underwriter that underwrites most of our files, we've worked together for about 4 years now, so I have a really good rapport. The reason why I like Supreme Lending is because we talk about guidelines, and really what we're referring to is Fannie Mae, Freddie Mac, and FHA and VA. So these entities have their guidelines, and Supreme offers a very pure path to those guidelines, as opposed to other mortgage companies that I've worked at where they're afraid that if they close the loan improperly, that the agencies won't buy the loan. And so what they'll do to protect the company from that happening is they'll impose a series of guidelines on top of the existing guidelines, and it sort of closes in the box in what people can qualify for, because they're essentially making the guidelines more strict and self-imposing guidelines on top of guidelines that already exist. Companies do this because they're afraid that if they close the loan incorrectly and they go to sell the loan to, say, Fannie Mae, and Fannie Mae doesn't purchase the loan, and they said, sorry, you didn't check this box, we're not buying the loan, then the alternative, and what they do in that instance, is they have to sell the loan into a scratch and dent market where they'll lose anywhere from 15 to 20 cents on the dollar. So a typical $200,000 loan, if closed improperly, could cost the mortgage company $40,000, which is actually a point that I'm glad you brought up, because that actually speaks to why sometimes a borrower feels like they're being feels like they're being interrogated by the underwriter, because the underwriter is asking for something that seems so insignificant. It could be like page 6 of a bank statement, and that page 6 might be blank, and there's no pertinent information on it whatsoever. Yet the underwriter is saying, we can't finally approve your loan because you don't have page 6 of the bank statement. Often the borrower interprets that as if to say, well, wait a minute, you're telling me you don't think I'm going to make my mortgage payment because I'm not going to give you a page 6 of a bank statement? It has nothing to do with the underwriter's feelings about the buyer's ability to repay the mortgage. It all has to do with the sale of the mortgage in the secondary market. And if we close that loan without that bank statement, well, simply the mortgage company stands to lose, $40,000 or $50,000.
Right.
All mortgage companies sell the loan in the secondary market. So even the big banks, like the brand names of B of A and Wells, they might service your loan and they'll collect your payments, but that loan still ends up getting sold in the secondary markets.
So what type of loans do you work with? Do you work with all loan types, or?
Yeah, all the traditional loan programs. So you've got conventional loans, which for people that want to buy as a primary residence, or someone that wants to buy a vacation home, or someone that wants to buy an investment property. FHA loans are geared to first-time home buyers, but not exclusive to first-time home buyers. And then, of course, VA loans for our veterans. We have a jumbo portfolio as well, where we have 9 different investors.
And what's that look like? So what's the difference between VA, FHA, and conventional for down payment and costs and all that? What would you suggest for a first-time home buyer? All those questions. What?
Yeah, everyone's situation is so different. So I recommend, I try not to recommend. What I try and do is spell out all their options, explain where certain scenarios might be better for certain profiles. For example, how long would you be in the home, or what stage of life are they in? Are they downsizing? Are they retired? So I try and spell out all their options, and allow them arm them with the information they need so that they can make the best decision for them and their family.
Right on. So for down payments, what's VA, for example, if someone's a new VA buyer?
VA is the best loan you can get. So if you've served in the military, you have access to the best loan program, in my opinion, which requires 0 down. It's 100% financing, and there's no monthly mortgage insurance. The interest rate on VA is actually the most aggressive as well. So you've got the lowest interest rate, the least amount down, and no mortgage insurance. So it's by far and away the best loan program.
What about FHA? What's that like?
FHA has similarly a lower interest rate as well. It requires 3.5% down, but it does have some pretty expensive mortgage insurance premiums. Mortgage insurance is of no benefit to the buyer. It's insurance in case the buyer defaults on the loan and walks away. Then it's insured by HUD, and HUD refunds the lender any losses that they're incurred for having to foreclose on the client and resell the house.
And then now conventional, there's a few options. So what's the most common down payment, and then what's the lowest down payment? And then there would still be mortgage insurance on something lower than 20%. So if you can.
Yeah, absolutely. So conventional, if you're going to live in the home, you can put as little as 3% down for those that are first-time home buyers. Other than that, if you've owned a home before, then you're going to need a minimum of 5% down, which would be accompanied with mortgage insurance. Now, conventional loans are hypersensitive to credit score in terms of interest rate. So if someone has a FICO score of, say, a 660 or a 680, certainly we're going to explore conventional as an option, but FHA might be better because FHA is not so sensitive to credit score as it pertains to interest rate. Also, the mortgage insurance is private mortgage insurance. So there's these third-party companies that are insuring the loan, and their prices are higher for those with lower credit scores as well. But for clients with pristine credit or a 740 credit score, then a conventional option is going to be probably a better option as opposed to VA, as opposed to FHA, because the mortgage insurance premiums are lower.
And it's once you get to 20%, correct, that the mortgage insurance is then gone?
Yeah, absolutely. So if you start out putting 20% down on a conventional loan, you won't have mortgage insurance. Or if you start out with 5% down, and then over time you've paid the loan balance down, you can get the mortgage insurance removed. For FHA, to take a step back for a moment, FHA, the mortgage insurance is permanent and could never be removed.
For the life of the loan.
Right, for the life of the loan.
So even if you hit 20%, it's for the life of the loan.
And even if you're putting 30% down on an FHA loan, there's still the same mortgage insurance premiums.
Right.
So tick lower, but basically. And it's in that case, actually, you could get it removed on an FHA loan if you put 10% down or more, but it's on there for 11 years, so it's going to be quite some time before you would get it removed.
So who do you typically work with? If you were to say the majority of your clients, are they FHA, are they conventional, are they first-time home buyers, investors? What's your go-to, or is it all of the above?
Everyone. I enjoy a lot of different. I really like what I do, and I enjoy the first-time home buyer and walking them through the different options and then introducing down payment assistance and helping them make the best decision. I just met with a first-time home buyer yesterday where she elected to not go with the down payment assistance program because the rate was higher, and she realized, after we did the math, that while she might save money up front, after 6 years she'll actually end up losing money by going through the down payment assistance program, and she elected to not go with the down payment assistance program.
So you touched on something. So here in Las Vegas and potentially in other metropolitan areas, there are down payment assistance programs that you can utilize in conjunction with your loan. So can you explain some of their options that they have currently, and what that would look like?
Yeah, so the most common down payment assistance program is called Home is Possible. And it's essentially anywhere from a 3 to 5% of the loan amount grant that will go towards your closing costs or down payment. There is the caveat, though, that the interest rate is higher and the fees are higher as well. So in the long run, if you're in the mortgage for 6 or 7 years or longer, often that option will end up costing you in the long run. However, it's a great tool for home buyers that simply just don't have the down payment.
Right. So it gets you in the home. It allows you to purchase the home.
Exactly.
Cool. So if you have a good credit score, if you're stable in every other capacity, but you don't have the cash, you could potentially utilize a down payment assistance program.
Absolutely.
Cool. So what is the difference between you and one of the major banks in terms of mortgage lending? What would you say is a big difference?
Yeah. So the first analogy that comes to mind is that we're just a mortgage company. First of all, what I mean by that is that some of the brand names, they're offering a menu of services, from checking and savings to auto loans to insurance, investments. commercial loans. And in my mind, it's hard to be really good at everything. And that's why I like Supreme Lending, because they're just a mortgage company and they're able to really sort of specialize in what they do and become really good at what they do. So it's a great company to work for, because again, all they do is mortgages. They eat, breathe, and sleep it, and they're a very good company to work for.
So what is something that buyers wouldn't expect in the process, that you come across all the time, that buyers just would have no idea is coming, and maybe a cost or a fee or an obstacle that they need to overcome, or documents they need to provide? What's something that always sticks out that they usually miss?
So for me, it's the misdiagnosis of income calculation. A buyer goes through their finances and they realize, I can afford a mortgage of $1,500 a month, or as an example, and they feel like they earn enough money to be able to make that payment. But the misdiagnosis of how an underwriter is going to calculate your income is where most of the loans that are pre-approved and then turn out, after it goes to underwriting 3 weeks into the process, that they can't secure the loan. That's most often where it occurs. So for me, that's my biggest nightmare. So we really take the time to make sure that the income calculation that we're using to run through the automated underwriting system and get the automated approval, that income calculation is going to be consistent with the income calculation that our underwriter is going to use.
So what would be your advice, your one or two pieces of advice for a buyer starting off?
Yeah, they really need to get with an experienced, knowledgeable loan officer that really understands the income calculations as the way the underwriter would calculate the income, because that's what ultimately could cause a pretty painful, emotionally challenging situation to be
Absolutely.
Emotionally invested into buying the home, only to find out 3 weeks in that they don't qualify, and it's almost always income related.
Cool.
So definitely get with a loan officer that understands those income calculations. Ask the hard questions. How long have they been in the business? Do they, how's their relationship with their underwriter? How are their guidelines? Don't be afraid to ask those hard questions.
Right on. So, what are your thoughts on Las Vegas? Are you positive in the next few years and long run? Do you feel that we're going strong? Do you have any concerns, or all hopeful?
Yeah, I've studied the real estate market and thought about it quite a bit. As I've been a loan officer for 19 years here, so I've had a front row seat to the ups and the downs, and then the back up again, in terms of value. So I've thought about it a lot and studied a lot, and what I've come to the realization is that as long as the home is as close to as affordable to rent that it is to own, you'll always be okay. So if you look at what home values did from 2000, the median priced home in Nevada was around 142,000, and in 2007 it was over 300,000. That's almost 20% appreciation a year. So for starters, a healthy as a gauge, a healthy real estate market will have anywhere from 2 to 4% appreciation a year, and we saw 20% a year for 7 years straight.
Yeah.
Now, had you paid attention to the rents during that time, you would have noticed that there was a massive gap between the cost to own a home and the cost to rent a home. The $300,000 home to own would have a mortgage payment of $2,000 a month, and that was on a program that was an adjustable where you were only paying interest.
Oh God.
So that's $2,000 to own a home versus renting that same home probably was only going to cost you $1,200. That's
Wow.
a significant gap, $800 a month. So you might be thinking, well, why did anyone buy a home? Well, they were betting that the house was going to continue to go up 20% a year. So that $800 deficiency or additional cost to own the home would be offset by the 30 to 60,000 that the home would appreciate.
20% appreciation.
Exactly. I mean, it's been appreciating for 20% for 7 years. Why wouldn't it continue, right? So moving forward, what's interesting though is now you go to fast forward to 2012, and now the median priced home is 112,000. So here we are, 12 years later from 2000, and we're actually down 10 or 15%, and that's not exactly 2 to 4% appreciation a year.
Right.
However, obviously it was an overcorrection, and the market supported that opinion that it was an overcorrection because values went right back up, and here we are 5 years later with a median price home is 265. What's interesting though is if you drew a line from 2000 to 2017, median price home was 142, now at 265. You're actually running at around 4% a year. So a wild ride to get there, but actually where the prices are at the moment are probably right where they belong, especially when you consider the tax climate, the actual weather climate, the sports teams that have moved to the city, and all the great things happening here. When you factor all those in, it should be of no surprise that 4% appreciation over the last 17 years is something that's sustainable and something that's healthy, and that we're probably priced about where we should be.
That's awesome. All right, so how can people find you and contact you? What's the best way for them to contact you?
Yeah, my personal cell, always 702-372-2427. You can visit my website at www.maltesemg, M as in mortgage, G as in group.com. That's it.
Awesome. So I'm Zach WalkerLieb. You could reach me at zacharyw.cbvegas.com or visit my blog, thesageinthepine.com, and you could reach me on my personal cell as well, 702-743-9998. Thank you for tuning in for our first episode.